Elon Musk is preparing the largest initial public offering in human history, aiming for a target valuation of $1.75 trillion. This comparison chart shows the scale of that ambition. At $1.75 trillion, SpaceX would be worth more than every American defense contractor combined. It would eclipse the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks put together. Even when measured against the top 10 companies on the London Stock Exchange, the valuation remains larger than all of them combined. However, the numbers on the balance sheet do not match the grandeur of the price tag. The company seeking this record-breaking valuation is currently losing $5 billion every year. This creates a significant question for the market. Who is willing to buy into the most expensive IPO in history while the company is hemorrhaging cash? The buyers for this IPO are not limited to private equity or hedge funds. Because of how the modern financial system is structured, millions of standard retirement accounts are positioned to absorb these shares upon arrival. The value of those shares depends on the three distinct businesses operating under the SpaceX name. Most people view SpaceX as a rocket company built to colonize Mars. This revenue breakdown illustrates how the rocket division, which handles missions for NASA and the U.S. government, actually accounts for only about a quarter of total annual earnings. The true engine of the company is Starlink, a satellite internet provider that has become the fastest-scaling telecom company in history. This chart shows Starlink taking over the business, generating over $11 billion, accounting for 61% of total company income. The efficiency is accelerating too. Over 2 years, profit margins climbed from 41% to 63%. If SpaceX consisted only of Starlink and its launch services, the business would be highly profitable, generating roughly $8 billion in annual profit. But the financial picture changed when SpaceX acquired Elon Musk's AI startup, xAI, in an all-stock deal. This comparison scale highlights the cost of that acquisition. SpaceX paid $250 billion for a company generating only about $1 billion in estimated revenue. xAI is currently burning through more than $1 billion a month. Since its founding, the entire original team has left the company, forcing him to admit that the project needs to be rebuilt from scratch. This visualization shows how that spending impacts the bottom line. The $8 billion in profit earned by Starlink and the rockets is entirely consumed by xAI's operational losses. The consolidated entity is now a business that lost $5 billion last year. This deficit makes the target valuation dependent on the mechanics of the financial exchange itself. The process of taking an unprofitable company public at this scale takes place on the Nasdaq. The exchange recently implemented a series of rule changes that impact how new stocks enter the market. The Fast Entry rule cuts the 3-month waiting period to 15 days. The 10% public float requirement is removed, allowing SpaceX to qualify with 4%. Finally, a hidden multiplier treats that float as 3 times larger, legally manufacturing demand. These tailored adjustments eliminate the standard seasoning period and price discovery phase, creating legally mandated demand for a stock that would not have qualified 6 months ago. The Nasdaq 100 serves as the gold standard for growth companies, with over $600 billion in passive capital tracking its every move. Once a company joins the index, those funds are required to buy the stock. These rules ensure that passive retirement accounts and index funds will absorb SpaceX shares at their peak valuation, regardless of the company's profitability or the investor's individual choice. Passive investing is presented as a safe, democratic way to build wealth over time by removing the risks of individual stock picking. But the same mechanism that makes these funds convenient now functions as a funnel. Millions of individual 401ks are being positioned to provide the exit liquidity that allows early insiders to cash out at a $1 trillion valuation.